What is going on, guys? Mark Roberti here. In this video, we're going to talk about buying calls. There are three reasons why it would make sense to buy a call. In case you guys don't know what a call is a contract that gives you the option, but not the obligation, to buy 100 shares of a company at a set price. So you may be thinking, well, why don't I just buy the 100 shares now? Well, there are a few reasons. One is if we are heading into a company's earnings report, and a lot of companies, they tend to spike during the earnings report. They either spike up or they have a big downward trajectory because of what the earnings report said. And we have an idea sort of like what we think will happen, but at the end of the day, we're all just guessing. And it's one thing to guess by saying, okay, let me buy 100 shares of this company the day before earnings and then hope it goes my way and that, there's no big drop. Part of the reason people do this is because if the stock shoots up like 5% or 10% into stock they want to hold long term, then you want to get in on that and not miss the big earnings spike. If it's something that drops in earnings and it's a bad report, it's like, oh, what a shame. I'll just hold and hope for a rally, something like that. But there's a better approach, and that is to buy a call that expires right before earnings. You don't need one of these long-term calls for this strategy. Long-term calls, they cost more because the expiration date is further away. But if you're using it just for this strategy, then all you really care about is what happens to the stock, like how it reacts to their earnings report. So let's say the stock shoots up. Now you bought a call right near the current price of the stock, or maybe right at the money. And sure, it cost you premium to get that position, but now you're able to buy the stock at an attractive price the way it was pre-earnings, even though it has shot up after it released the earnings report. Now, the reason you buy this call, though, is because, well, what if the stock plummets after earnings because of some unfortunate surprise? In this case, the call is going to get decimated. Like, you're not going to have much left on it because the stock price moves further away from the strike price, and not in the good way. So what happens, though, is you just lose the value on the call instead of if you bought 100 shares before earnings. I'd rather see a call get decimated than see 100 shares get decimated. And then because you didn't buy the stock before earnings, you could buy it after earnings with the big drop in effect if you do want to buy on that dip. It's not always good to do that, but for companies with good long-term potential and a few catalysts, it would make sense to buy on a dip. So if you do buy a call right before earnings that expires that same week, it will give you the ability to capture upside of a good earnings report and protect yourself from significant downside if there is a bad earnings report. The second reason it makes sense to buy a call in this scenario, if you short a stock. Now, shorting a stock is a very risky game, and the big deal here is that you've got the potential for unlimited losses. If you look at Tesla shorts, a lot of them got destroyed because they shorted the stock pre-split a year ago when we're only really looking at like $200 a share. And, pre-split, like at its peak, like we're talking in the neighborhood of over $2,000. So you could imagine like what type of catastrophic losses that would entail. So if you buy a call on a stock that you are shorting, you cap your downside. This is the only way to cap your downside on a short position, with the exception of if you just decide to close out the short position or something like that. But buying a call, it does cap the potential downside that you can face. I feel like if you are into shorting stocks, I do not short stocks, but if you are into it, then you should buy a call to protect yourself in case the stock suddenly spikes upward, because there were a lot of reasons to think, like there are a lot of bearish arguments about Tesla, like, oh, this thing's going to stay flat or this thing's going to go down. You got a lot of volatility. But then, you know, it all makes sense until you're wrong, and then all your theories don't make sense anymore. So that is one. And even in some cases, like all the stuff you're saying makes sense. You've got a really solid argument, but then the stock just says, nah, I'm going to go up even more. I mean, if you look at something like Nikola Motors, like there is a lot of like, you know, fraud and like there's a lot of murkiness with that situation. And yet things skyrocketed recently. The way the market works sometimes. So that's why buying a call is really great if you are shorting. I don't recommend shorting anyway, just to be honest, but I thought I'd throw this one in there. The third time it makes sense to buy a call is no, not the YOLO. A lot of people, in case you guys don't know what the YOLO is, some people literally, they take their entire portfolio worth, slam it into like one call, hoping they like make a fortune, and if it doesn't work out, you lose all your money. Don't do the YOLO. If you don't know what it is, good. Don't try and do any research on it. But the third reason you would actually want to buy a call is to close out a covered call. So a covered call, in that case, you sell a call to someone and you get the premium. And there are a few scenarios where it makes sense to close a covered call. One could be is you want to take profits a little early, because, you know, if the stock like shoots up tomorrow, then it's going to be harder for you to pay off that covered call, or you just wait for it to expire, in which either it gets exercised and you lose the 100 shares, but you get, you know, the payment, or you just sweat it out, which for a long-term position, especially one with big tax implications, I don't like the idea of sweating that out. So those are just some of the reasons why you would buy a call, to just close out a position you don't want to have anymore. Some people, I do this sometimes, I will buy a call to close out the position and then immediately sell another covered call at a different strike price to collect additional premium. And I usually do this as a way to just make some extra income. So if the stock decides to fall down significantly, I will sell the existing, I will buy a call to close out the covered call, and then I will sell another covered call right away to just make some extra premium. So that is one of the strategies options traders use. And buying calls, I mean, they are a really great instrument for just hedging and also being able to see some solid upside. If you guys enjoy this video, make sure you subscribe for more just like this one. Let me know in the comments what videos you guys want more of, because again, this is a very new channel, and I will see you guys next time.